Hello everyone, and welcome back to Boss Economic World. I'm your host, the guy who reads the central bank footnotes so you don't have to suffer through the boredom. Today is November 27th, 2025. Happy Thanksgiving to our American friends, but here in Europe, nobody is eating turkey. Instead, the European Central Bank is eating humble pie, and the bond market is suffering from massive indigestion. Today, we are going to talk about something that sounds about as exciting as watching paint dry in a clog factory, Dutch pension reform. Wait. Don't click away. I see you reaching for the mouse. Put it down. Because what if I told you that a bunch of actuaries in Amsterdam are the reason why your mortgage rate is stuck at 6%, why your government can't afford to fix the potholes, and why the global financial system is currently sweating bullets? The butterfly effect is real. A pension fund manager in Rotterdam decides to change his hedging strategy, and suddenly, the entire Eurozone yield curve goes vertical. Today, we are going to peel back the onion on the ECB's latest terrifying warning, analyze the truth behind the Great Rotation, and explain why the biggest whale in the European bond market is swimming away just when we need him the most. Buckle up. We're diving into the plumbing of the financial system. Let's start with the news. Yesterday, Wednesday, November 26th, the ECB released its Financial Stability Review. Usually, these reports are 100 pages of bureaucrats congratulating themselves on how stable everything is. Not this time. This time, they sounded the alarm. The ECB explicitly warned that the reform of the Dutch pension system is going to trigger a massive sell-off in long maturity bonds and interest rate swaps. Now, why does the ECB care about the Netherlands? It's a lovely country, great cheese, beautiful canals. But economically? Here is the killer stat. According to the ECB, Dutch pension funds account for 65% of all euro area pension funds' sovereign bond holdings. Let that sink in. 65%. The Netherlands is the whale in the European bond bathtub. For the last 20 years, whenever a European government issued a 30-year or a 50-year bond to fund a bridge or a bailout, the Dutch pension funds were there to buy it. They were the guaranteed buyer. They were the floor under the market. But now, the whale is leaving the pool. And he's taking his liquidity with him. To understand why this is happening, we have to look at the mechanism. What is actually changing? The Dutch are moving from a defined benefit system to a defined contribution system. In the old world, the pension fund promised you a specific payout every month until you died. Don't worry, Hank, you get €2,000 a month forever. To make that promise, the fund had to buy super safe, super long-term assets to match that liability. If I owe you money in 2050, I better buy a bond that pays me in 2050. This created an insatiable appetite for long-dated sovereign debt and interest rate swaps to hedge the risk. In the new world, which is fully kicking in over the next 2 years, the deal changes. Now the fund says, look, Hank, here is a pot of money with your name on it. We'll invest it. If the market goes up, you get a yacht. If the market goes down, you get, well, less. This shifts the risk from the fund to the individual. And crucially, it changes the investment strategy. A defined contribution fund doesn't need to hedge interest rate risk 30 years out with the same intensity. They care about growth. They want equities, they want private credit, they want infrastructure projects. They do not want a 30-year German bond paying 2.5%. So, what happens? They sell the bonds. The ECB put it politely in their report, there is lower demand for longer-dated debt from some institutional investors. As a result, investors may require higher yields to absorb new issuance. Translation, the price of long-term debt is going to crash, and the interest rate is going to skyrocket. Now, if this were happening in a vacuum, maybe we could handle it. But we are not in a vacuum. We are in late 2025, and the macroeconomic backdrop is, to put it mildly, a dumpster fire. Let's look at the three factors colliding right now to create what I call the liquidity void. Factor 1, the fiscal pivot. Throughout 2025, we've seen a massive pivot among European governments. The war in Ukraine is dragging on, NATO requirements have hardened, and the green transition is behind schedule. Germany, France, and Italy are all issuing record amounts of debt to fund defense spending and infrastructure. Governments are issuing more long-term bonds just as the Dutch are quitting the game. It's simple supply and demand. Supply is up, demand is down. Price goes down, yields go up. Factor 2, the ECB's betrayal. Remember the good old days of quantitative easing? When the ECB would print money and buy bonds? Those days are gone. We are deep in the era of quantitative tightening. The ECB is actively shrinking its balance sheet. They are letting bonds roll off. So, the ECB isn't buying. The Dutch aren't buying. Who is left? The ECB report says there is now greater impetus on private buyers to absorb the supply hitting the market. Private buyers. That means hedge funds, asset managers, and you. And let me tell you, private buyers don't buy bonds for charity. They buy for profit. They will only step in if the price is low enough, which means yields have to go higher. Factor 3, the volatility spike. Earlier this year, we saw long maturity yields hit multi-year peaks. We had bouts of extreme volatility in the spring and late summer. Why? Because the market is sniffing out this liquidity crisis. When you try to sell a block of 30-year bonds and the Dutch bid isn't there, the price gap's lower. Let's get technical for a moment for my finance pros in the audience. Let's look at the swap curve. Specifically, the gap between the 10-year and 30-year interest rate swaps. At the start of 2025, this spread was inverted around minus 20 basis points. That means 30-year rates were lower than 10-year rates, which is weird, but that was the demand from the Dutch hedgers crushing the long end. Today? As of late November 2025, that spread is around positive 32 basis points. That is a massive, 52 basis point swing in less than a year. This is what we call a bear steepener. Long-term rates are rising faster than short-term rates. Why? Because the Dutch funds are unwinding their hedges. They don't need that 30-year protection anymore. The steepening trade was the hot bet earlier this year. Everyone piled in. Then, in October, it petered out. Why? Because people got nervous. Are the Dutch really switching? Is the regulator stalling? But in recent weeks, the trade has ripped higher again. Why? Because the regulators gave the green light. The Dutch central bank confirmed they are working for a smooth transition, which is code for it's happening, brace for impact. Bank of America came out this week and said they are keeping their trading desks fully staffed over the Christmas and New Year period. Do you know how rare that is? Usually, bankers are skiing in St. Moritz by December 15th. If Bank of America is keeping the lights on, it means they are terrified about a massive volatility event during the low liquidity holiday season. They smell blood in the water. So, why the urgency now? Because 2026 is the cliff edge. According to analysis by BNP Paribas, the early part of 2026 is the key test. About 35% of the Dutch pension sector's assets are due to switch over in early 2026. Total assets under management are roughly 1.9 trillion euros. That's massive. We are talking about hundreds of billions of euros of collateral and bonds potentially hitting the market or being reallocated within a window of a few months. The ECB is warning that this could lead to a compressed maturity profile. That's fancy talk for, nobody wants to lend money for 30 years anymore. If the market refuses to buy long-dated debt, governments will be forced to issue shorter-term debt. But that makes the financial system more fragile. You have to refinance more often. It's like paying your mortgage with a credit card that you have to renew every month. It works until it doesn't. Okay, boss, enough with the basis points and swap curves. What does this mean for me? 1. Mortgages and consumer credit, long-term swap rates dictate fixed-rate mortgages. If the 10-year and 30-year yields rip higher because the Dutch are selling, your mortgage rate goes up. Even if the ECB cuts short-term rates, your mortgage rate could stay high or go even higher. This is the nightmare scenario, economic stagnation but rising bond yields. 2. Taxpayer pain, governments are borrowing at higher rates. The cost of servicing the national debt is exploding. In France and Italy, debt service is already one of the biggest line items in the budget. If yields spike, that money has to come from somewhere. Higher taxes or fewer services. 3. Financial accidents, whenever you have a shift this big, things break. Remember the UK pension crisis of 2022? Where the Bank of England had to step in to save the market? The Dutch transition is managed better, yes, but the scale is larger. If liquidity dries up, we could see a flash crash in European assets. Let's analyze the truth behind this event. Why is this happening really? It's demographics. It always comes down to demographics. The defined benefit system was a Ponzi scheme that worked when you had 5 workers for every 1 retiree. Now, Europe is aging. The Dutch population is graying. You cannot sustain a system that promises guaranteed high returns in a world of shrinking workforces and structural inflation. The shift to defined contribution is an admission of defeat. It is the system saying, we cannot guarantee your future anymore. You're on your own. The bond market sell-off is just the symptom. The disease is the end of the post-World War II social contract. The irony is rich. To save the pension system for the elderly, the funds have to sell the bonds that fund the government, which makes it harder for the government to care for the elderly. It is a feedback loop of doom. So, what are we looking for in the coming weeks? Watch the 10s-30s spread in the euro swap market. If it breaks plus 40 bps, things are getting disorderly. Watch the German bond auctions. If Germany, the gold standard of credit, struggles to sell 30-year bonds, panic will set in. And watch the ECB. They warned about this on Wednesday. If yields spike too high, will they blink? Will they stop QT? Will they invent a new acronym tool to buy bonds again? My bet? They will have to. The private market cannot absorb the Dutch exodus, the American deficit, and the European defense spending all at once without yields causing a recession. The Dutch pension reform is not just a technical adjustment. It is a tectonic shift in the financial geography of Europe. The continent's biggest piggy bank is being smashed open and rearranged. For the last decade, we complained about low yields. We complained that safe assets paid nothing. Well, be careful what you wish for. The Dutch are leaving the bond market, and they are leaving us with higher rates, steeper curves, and a lot more volatility. If you are a trader, get your coffee ready for December. Bank of America is keeping the lights on for a reason. If you are a homeowner, lock in your rates. And if you are a Dutch pensioner, well, hopefully, the stock market keeps going up. That's it for today's Boss Economic World. I've restored the full picture for you. The Dutch sell, yields rise, the government pays more, and the risk is transferred to you. If you like this analysis, smash that like button. It helps the algorithm more than a defined contribution plan helps your retirement. Subscribe for more updates as we track the 2026 cliff. I'm the boss, and I'll see you in the next crisis.